Okay, now YouTube works, but now I can't get the VTF screen share to work. Alright, I'm just going to read the disclosures summary on YouTube while the VTF figures itself out. Oh, here we go. I am associate member of T3 Trading Group, which is an SEC registered broker-dealer and member of FINRA SIPC. You should carefully consider whether trading is suitable for you in light of your own financial condition. Position disclosure remains unchanged. Okay, yeah, so kind of a nothing day for the market. Like, Pat and I were just chatting about a little bit into the close on the VTF, despite, once again, a lot of headlines, a lot of volatility. It didn't really change anything as far as our kind of big picture technicals go for the market. We're still in a bearish market. A bear market for the NASDAQ, a bear market for the IWM, a market correction for the S&P, a bearish market is the way I would just describe that across the board. We're pretty much downtrending on every time frame, except for arguably the biggest time frame, which is probably just about trendless at this point, as this 200-day is really flattened out because we started to spend a decent amount of time below that 200-day. I keep saying that if we can kind of recapture this 430, recapture this negative Maribozu here, the high of which is 432.30, that it would provide some ammo for the bulls. But even with that, I mean, that would be a good step. But even with that, I don't think that this market becomes unbearish and comes back to neutral territory until we get back to 440. We got to get above and close above 440. And then at this point, we only become bullish, I think, if we're getting above, 458, which is quite a ways away. But we do know that bear market rallies can be strong and ferocious when they come. There's going to be no real difference here in our Q chart. Kind of a similar situation here. Despite the Amazon news yesterday, it was a pretty, weakish type day overall for the NASDAQ. Percentage-wise, SPYs closed down 0.4%. It's not terrible. Qs are down 1.15%. And again, that's with Amazon being up 6%. So what is Amazon's weighting in the NASDAQ? Like 7% of the NASDAQ or something like that? So it really just shows you just how brutally weak the NASDAQ really was today. I mean, Apple down 3% on the day. Microsoft, I guess, not as bad. Microsoft down 1.25%. Facebook down almost 2%. So yeah, similar situation here for the NASDAQ, right? We got to get back above this negative Maribozu high. Really, we got to get back above 340 to start showing some improvement. Probably we get to neutral territory above 350 and bullish territory, above the 200 simple moving average, basically at this point. The Russell here, IWM, once again, a beacon of relative strength, closing flat on the day. $200 is kind of the big key inflection point where I think the IWM goes from bearish to neutral, and we closed right on it. We closed just above it yesterday. We closed right on it today. IWM closed at its intraday highs, literally right into that $200. So we'll see how we gap tomorrow and if the IWM is actually able to reclaim that or not. So overall, it's a bearish market. The only somewhat positive thing I could even attempt to say is that we didn't break down further. And that, I guess, is not the most bullish statement. Oh, thank God it was such a bullish day because we didn't break down, right? Because we easily could have. At one point today, I thought the price action looked really poor. So let's recap the intraday price action here. Just a good lesson on gaps. So I think I go over this in we is tomorrow morning. I think I go over this in my gap class a little bit, but I just want to talk about briefly common gaps and common gaps getting filled or not getting filled. So everything else held equal, which is an economist term that I hate, everything else held equal, common gaps tend to get filled. They get filled at a higher probability. So if a common gap higher, that means that most likely you're going to see some intraday downside price action. You get a common gap lower, most likely you're going to see some intraday upside price action in order for that gap to be filled. And the reason why, again, is because of supply and demand function. In a common gap up, anybody who had longs overnight they're coming in and they're happy to book some profit. In a common gap up, if you were short, it's probably not gapping up so much that you're panicking out of your short position, that you're getting squeezed. And if anything, you're inclined to add to that short position because you're able to get better prices. So that creates the selling pressure that would fill an upside gap. And then a common gap to the downside is going to be the opposite. If you're long, it's probably not so bad that you're panicking out of your positions, and in fact, you might be inclined to buy more at a cheaper price. And if you're short and it gaps down, you're going to be likely to just book some of that profit. And again, that tends to lead to more buying than selling, and that tends to make the market go up a little bit. Now, that's in a perfect world where everything is held equal. We're not in a perfect world. And yesterday, we were able to do a really good analysis of why the common gap up did not get filled, right? Anybody who missed that can check out the afternoon meeting from yesterday on the Derrick the Trader YouTube. That's why I broadcast them now. So the other thing that I want to talk about, though, is it's not just that you're living in a vacuum. Everything's not just a perfect world. There are many factors that affect price action. And those factors are generally what we call layers of probability. And that's why it's important not to just memorize things. We need to understand the supply and demand implications behind them. So one of those factors, those layers of probability that we talk about, is what we call time frame continuity. Time frame continuity is basically what the trend is showing us on multiple time frames. Right now we're in a downtrend. So basically what that means is when you're in a downtrend, most likely things are going to go down, right? Again, let's just think about it in a perfect world for a second. If every market that you're looking at, if every time frame that you're looking at is trending lower, are you going to be more likely to make money short, or are you going to be more likely to make money long? You're going to be more likely to make money short, right? So now let's apply that layer of probability onto gap theory, okay? So the market right now, we basically just said, is trending down on just about every single time frame. So if you get a common gap to the upside, that's going to have an even higher probability than usual of getting filled, right? Because downside time frame continuity of trend. Common gap up, that's why I was saying yesterday, your typical book of technical analysis is going to say that we're going to fill the gap. And a common gap down in a downtrending market will actually have a lower probability than typical of being fully filled. So a lot of times what we end up seeing is when you have a common gap that's in the direction of the trend, meaning a common gap down in a downtrending market or a common gap up in an uptrending market, the gap doesn't fully get filled. But you still have the issue at the open, especially if it was a decently sized gap, you still have the issue at the open of dealing with extension. And again, we talked about the extension that was created by yesterday's gap up. We spent a good bit of time talking about that, both in real time yesterday and then yesterday's afternoon meeting. It's another thing, again, you guys can check that out if you want to go back and look at it. But basically, the way that I measure extension, I think everyone knows, is where price action is versus the space between the 8 and 21 EMA. So when you're gapping all the way down to 422.50 or so like we did today, and you closed up here, you got $5 of extension on a small time frame chart. You got $5 of extension to the downside on this 5-minute chart. And 5-minute charts tend to be the most important time frame to look at in definitely the first 30 minutes of the day, really more like the first 45 minutes to first hour of the trading day. So the question is, all right, we're having a common gap to the downside in a bearish market. What is the probability that that gets filled? It's still a decent probability that that gets filled in some way or another, but not super high because it's in the direction of the trend. But there still has to be some sort of price action here that is going to satisfy the opening downside extension. And there's two ways in which extension gets satisfied. And so first of all, an extended market can always become more extended. We could gap down and start immediately puking. That tends to be more in like a breakaway gap or something like that. But we're in a weak market. There's lots of headlines out there. We could open down and be extended and become even more extended. But most likely you're going to need to have time or price correction. So you could have time correction by the market just going sideways, like it did in the beginning of the day today, and like it also did in the beginning of the day yesterday. We had time correction. It's actually funny just how similar yesterday's price action is to today's price action, just in opposites. Yesterday was a really big gap up that had us extended. We tried to be time correcting for 20 minutes, but then instead we ended up price correcting to the ADMA before giving the rally. It was only at this point yesterday at lows that we were no longer extended on the small time frame. So same thing here. We're trying to time correct for the first 20-25 minutes or so this downside gap. And that's actually super bearish if that can fully happen. Meaning if this market just stays going sideways, it never upticks at all, it never price corrects, that shows you that you're dealing with an extremely weak market. It basically then would be a bear flag on this time frame, with the gap itself being the flag. And then if the ADMA catches up to this price action, like if we didn't rally here, and this ADMA kept working its way down, and a little bit later we caught up to, the ADMA gets to like, 423.50 or so it's catching up to price action, that's basically a bear flag. So you're looking for lower price action from there. So, but what ended up happening, again, somewhat similar to yesterday, we were trying to time correct the gap, and then we ended up price correcting, so it was a little bit of both. Today we were time correcting the gap for 25 minutes as ADMA is accelerating down, but then we actually broke up. We broke up, and this was a good little bounce here, but it wasn't one that you could believe in. It really wasn't one that you could believe in, and that's applied to yesterday too, but probably even more so today because of the layer of probability of downside time frame continuity across multiple time frames for the indices right now, because we're in a bearish market. So this rally is nice and all, but it's not something that you can trust. And that's why I was saying here, I don't want to see, if you're bullish, I'm saying this in real time, I don't want to see the market lose this 5-minute low. If we really are going to have the bulls make a stand, then maybe we can get a rest bar after this snapback to equilibrium and actually break up. And we actually got like a couple of rest bars in a row, which again, that's actually technically not bullish because it enables these moving averages to catch up further. And as we get closer to 10:15, 10:30, we also really got to start paying attention to our 15-minute charts. Because sometimes, depending on the degree of weakness or the degree of strength in the market, just the 5-minute, price or time correction is all you're going to get. But if the market isn't super weak, and it actually turned out that today was not like a super weak day, then maybe you end up getting more of a 15-minute time or price correction. And I think as everybody knows, because I say it probably every day, once it starts to be about 10:15 a.m., if the market's given a big opening move in one direction or the other, I'll start to say, all right, guys, we've come down a lot this morning, we've gone up a lot this morning, but now it's approaching 10:15. Most likely this degree of acceleration or deceleration can't continue, and we should expect some sort of 15-minute correction to come into the market through time or price. So that's really what this ended up being today. We really ended up having a 15-minute time, but mainly price correction in the market before we got weak. And I think that the big signal for today was this 15-minute candle that I was calling out as it was forming. Basically like a shooting star type candle into the ADMA on the 15-minute chart. So this is the market attempting to fill the common gap, right? This gap this morning, even though it was sizable on a percentage basis, we've been seeing big gaps every day, it wasn't breaking like any, we weren't back below 420 in the SPYs, which has been like kind of a key level, even though we were below it on this one day. It's not like we were breaking back below 420. It's not like we were really breaking back to new lows. So people who did manage to be able to be long yesterday are even though it's below yesterday's low, they're probably not panic selling. They might even be considering buying more. And anyone who yesterday said, all right, I'm shorting into the close, into this pullback. I think the MOC was a big sell imbalance yesterday that pulled us back a little bit. We're back in equilibrium. I want to put my shorts on. Those folks are potentially doing some covering. So you do still have that supply-demand dynamic that can kind of create a little bit of a bid here. But that bid is not strong enough in a bearish market to be able to fully fill this gap. It just really led to a time price correction. And in this case, that was on a 15-minute chart. And that's why I said, this was the key signal here. and I was communicating in real time at 10:15 as that candle was forming. Also, you can look at the 5-minute chart. Usually, your 8 EMA on a 15-minute chart corresponds with a 21 EMA on a 5-minute chart, just in case people didn't know that. So, once we kind of had, so we just saw it's like a shooting star on the 15. It's basically what we call like a king-queen reversal on a 5-minute chart into the 21 EMA. Once this bar came in and closed, and then especially once we got back into the opening range that I discussed, and we lost this break higher bar that happened at 9:55. Once this happened, I was done with this market for the day. I ended up having a very low volume trading session for me. I really did not do a whole hell of a lot today. But for me, I was like, any attempt by these bulls at this point is probably over. And it's probably over for the day. And it's just a matter of, are we going to have another really weak breakdown day or not? And that's why I said earlier when I was chatting with Pat and when I was chatting with you guys when the meeting here started, the only thing I can even say that's kind of bullish about the market today is that we actually didn't break down more, that we didn't get acceleration to the downside, given that we are bearish on every time frame right now, and that we're no longer extended. It's one thing, when we're like at these lows and these lows and this low, and we're measuring, degrees of downside extension, and can the extended market become more extended, or can we see some sort of bearish snapback rally? You can't expect that in the same way here. We really should have, in some ways, almost given more downside continuation. But I don't want to overread that. It's one little piece of information, the fact that we happen to not break down today in a low volume trading session, one of the lower volume days that we've kind of had in a while we're still below all our key levels and still below and still basically downtrending on every time frame. So this market by no means looks good. I thought it'd be a good exercise here for us to kind of analyze a little bit how this type of gap works and what it means, especially in conjunction with the layer of probability of time frame trend continuity to the downside. So that's that. As far as stocks go today, nothing really too exciting. I think that the fuel cell idea from the morning meeting was like kind of the trade of the day. Fuel cell reported earnings, and initially was trading lower on that earnings report. My brief look at the earnings report, I thought it looked okay. But a lot of the times if I'm seeing an earnings report, what I can do here in this type of situation is say, okay, where's the key momentum level on the upside? And if that key momentum level can break, then it proves to me that it sounds like the market is interpreting the report in a positive manner. And if it never breaks the level and the stock trades down or goes sideways or whatever because the market didn't like the earnings report, and it doesn't matter because I'm never going to be in the stock anyway. So basically what I discussed in the meeting is that there's a little bit of a resistance level in this area that's combined with an inside day yesterday. So you could be looking as an execution strategy for an inside day and up through $6.40 as a momentum trade. And it turned out to be a really good trade. The market decided they liked the fuel cell earnings, good volume coming in. Very quickly on the first bar of the day, you have your break of 640. So you'd be putting on maybe 16 cents of risk or so versus the low of the day, the low of the ignition bar here through that break of $6.40. And then this thing held up really well. Market was not trading well while this thing was building out an ascending triangle. Ascending triangle broke to the upside. And then, it ended up not giving any real follow through from that point on. But it was still, pretty good trade for the people who were involved in the break of the kind of daily spot that we spoke about in the morning meeting. So that one was decent. I know I was looking at plug a little bit in the morning meeting to see if plug could act as a secondary to fuel cell. I hope no one got suckered into this. I was thinking maybe above yesterday's high or versus yesterday's low, there could be a trade. That would have failed either way. It broke above yesterday's high, came right back down, and also managed to break yesterday's low, kind of all in one trading session. So that one really was not too fantastic. And then most of the other things didn't trigger. We spoke about XLE and we spoke about RIG again. RIG just gave a tight inside day today. That's actually a good thing. these things that are a little bit extended, you want them to rest, you want them to set up. So we do still have the rig set up for tomorrow that we can pay attention to. XLE had a decently strong day, an impressively strong day. You know, I've been pretty impressed here about how these energy stocks have been going up with oil going down. Obviously, you know, when oil had the huge move there, the energy stocks really ripped, and I felt that they got kind of extended. And now it's impressive strength that the energy stocks themselves are actually continuing to hold up, even as oil faded a little bit. So we talked about, you know, XLE possibly as a long versus yesterday's low, and you could have looked at some of the corresponding stocks that were there also. So, you know, that ended up being strong once again, and kind of being okay for anybody who got involved in it. But I mean, that's pretty much it. You know, I don't really have too much else to talk about. You know, I was trying to be involved in Apple a little bit at a couple occasions, but it was difficult and weak. And then, you know, once the market really gave that 15-minute shooting star into the ADMA that I just discussed, that was pretty much the end of the attempts for me to really be doing any buying at that point. I don't want to be fighting this market. I don't want to be fighting downside time frame continuity in a market that's no longer extended. The advantage there just isn't strong enough. You know, maybe when the opening price action is acting okay for the index and we're kind of working our way higher, it makes sense for me to try to do some selective buying. You know, I bought back some Bed Bath & Beyond, which led to no positive result for me. You know, I tried to, you know, buy back some Apple that I had sold yesterday. That led to no positive result to me. This Apple was actually incredibly weak. Oh, and the only other good one I think was this Amazon to the long side for people who were looking at it early. Yeah, the inside 5 and up as it got back above $2,900. I know $2,900 was the spot that Pat mentioned as his key level to be long above and short below. You know, when we're kind of coming into the morning meeting today, so that one kind of acted okay. That's pretty much it. You know, I really don't have anything to talk about today from a stock perspective. It was kind of a whatever, nothing type of trading session today. You know, so we got to do a little, you know, gap lesson review, and that's it. I'm happy to answer any questions that you guys have. So let's take a look at what people are saying in the virtual trading floor. Cool. Yeah, WeWork is tomorrow morning. We'll see how that goes. I'm still really surprised that this WeWork is not higher. Just to negate this news, it's weird to me that they came out. The stock went down 30% on bad news that was false, and the stock couldn't recapture any of it. There's just no eyes on this thing. From Cody here, I have a question about when you have a stock you want to trade around the open with a key level defined. But when it opens, it extends with the EMAs lagging behind, and it hits your level pretty quickly. I see those circumstances often, which I tend to not take the trade because I have no conviction with the stop loss while it's extended. Sure, there are other variables to take into account, but just wanted to know what your thought process would be. Sure, so it would help to have an example because those situations can vary a little bit. The biggest thing I want to know when I'm assessing that is, okay, the stock is extended as it's breaking my level. That's one thing. There could be great opening momentum, in which case it's not necessarily a bad thing. What I really want to know is the stop loss that I want to use extended? You know what I mean? Like, if the stock gaps up and it's already extended and then rips from there and it's breaking my level, and that ignition bar low, or whatever you want to call it, or whatever your stop loss is going to be, the opening low, whatever, if the ADMA hasn't caught up to my stop loss, that makes me a lot more nervous that the stock is extended from my stop loss than the stock is just kind of extended in general. Because if the stock is extended in general, I probably do extend. The stock is extended in general, but my stop loss spot is not. I probably do want to take that trade, unless it's a really ridiculous amount of risk, in which case it just doesn't make sense from a risk-reward perspective. But if my stop's not extended, just the stock's a little bit extended, I probably want to take that trade. Because one, it's got momentum. Otherwise, it wouldn't have been able to trade to become extended. So maybe that momentum can continue. There's a probability that it will. And even if that momentum decides not to continue, as long as the ADMA is caught up to my stop loss, I know that there's a lower probability of like a shakeout. There's a lower probability of me getting pushed out of the trade and then it's still working. If the ADMA hasn't even caught up to my stop loss yet, then there's a higher probability of getting shaken out of a trade that could still work, and that makes me nervous. I struggle to take that trade. There's got to be something that I'm really loving about this thing to be able to take it and have my initial stop loss be above the ADMA on that time frame. I got to really believe that ADMA can catch up to my stop loss really quick. But if the stock itself is just extended, but the stop loss is not, I have room. I've got breathing room. The momentum could come that could pay me. I could get a time correction or a price correction that doesn't stop me out, and then it could work. So I'll want to take that trade, and I'll also, though, maybe leave some room from a risk and game planning perspective to be able to add if it pulls back a little bit against me, but is still above my stop loss, if that makes sense. So yeah, definitely a good question there. Canada looking to boost oil pipeline flows to the U.S. So we got Rivian on earnings right now. Rivian trading down. That doesn't surprise me. Is anybody still short Rivian from the breakdown trade that we called it? Where did we call that trade? Was that which day was that? Was that here, right? Was it through 50? I don't remember which day we called it. Hope somebody still has that Rivian short. I can't believe this thing was a $180 stock for a hot minute. Really good team short trade there. I don't understand how they have any revenue. Q4 total revenues are 54 million, missing the estimate 64 million. Driven by deliveries of 909 vehicles. I didn't even know if they had that many yet. Revenue was $55 million. What is this thing trading at as a from a valuation perspective? Rivian sees fiscal year 2022 adjusted EBITDA loss of $4.75 billion. I've been saying that. I'm saying that from the beginning. It's just ridiculous. This company is going to have to lose so much money in order to ever become viable based on what their plan was on the IPO. They're going to have to lose so much money. And it's just a matter of, honestly, it's just a matter of whether our buddy Jeff, in his midlife crisis, is willing to fund the entire thing just over his little rivalry with Elon. So we'll see. Colgate with a new $5 billion buyback. Always love our buybacks, man. Love those buybacks. Is DocuSign still smoked? Yeah, DocuSign destroyed their guidance was a solid miss. DocuSign down 19%. Next question I'm seeing here is from Steve. If you're long on a bull flag and execute, where do you put your stop? Low the flag? Yes. Low the flag. Steve, you can check out my chart pattern class that I have in the training program. Part 1 talks about continuation patterns. I talk about the ways in which you can enter and where the stop loss should be. But yeah, generally the stop loss on a bull flag trade is going to be the lowest point of the flag. Generally, you want to be a little bit patient on the execution to wait for that ADMA to catch up, because it's only when the ADMA catches up that you tend to get continuation. Just going back to the SPYs here, you know, this is the beginnings of a bear flag with the flagpole itself being the gap. You want to wait. Yeah, you don't want to look at this and go, okay, let me short. You want to wait for the ADMA to catch up and then execute your short. Because if the ADMA didn't catch up, there's a decent probability of this happening. Or same thing as yesterday. If the ADMA didn't catch up to this base, which it didn't, there's a decent probability of this happening, of it shaking out the flag and then potentially even still working. So yeah, so it's that's your proper stop loss, but it's the entry execution that is also going to be really important. The timing of the entry execution and the specifics of it. You can execute in the pattern itself as that ADMA is catching up, or you can wait for confirmation by waiting for it to actually break the level. If you wait for confirmation, you're going to have a worse risk reward and a higher probability of success. If you don't wait for confirmation because you're anticipating the break because the ADMA caught up, you'll have a lower probability of success, but you'll have a better risk reward. From Rich, when you're buying a stock, do you always have offers already in? Do you ever buy at market price or bid? I have trouble entering a stock sometimes during the open because it ticks up down way too fast. Rich, I'm curious to know what trading software you use, because I know you're not actually one of the professional traders with T3 Trading Group that's on the team. You know, I'm curious to know basically if you have a direct market access provider, or you're using someone who is selling your orders out to HFT firms. Because if you're using a free brokerage and they're selling orders out to HFT firms, particularly in the open, when markets are spreadier and moving quickly, and it's the most important time to be able to execute, the execution tends to be much worse. But anyway, so whether I am taking the offer to get involved through some sort of uptick key or market order, or whether or not I'm bidding in, depends on the type of trade. I prefer, whenever possible, to use limit orders to enter trades, because I like to get rebates. As a matter of fact, I was just chatting with actually 2 separate people via email today about execution and ECN fees and how that works. It's very typical that I actually get paid by the exchanges at the end of a given month because I provide so much liquidity, and that's bidding and offering. The one times, one plural. I guess the couple times when you really have to take liquidity is if you're in like a real pure momentum trade on the entry, or if you have a stop loss that's triggering. That's when you really have to take liquidity. So again, it depends on the type of trade. Like a lot of those momentum type trades, breakouts, those off the open trades where it's ripping higher, you do have to kind of take the offer and mark it in. But pay attention to the spread when you're doing that. Make sure that spread's not too wide. And even in that case, I will try to bid in when I can. And the problem with doing that is sometimes I miss a really good trade. And it's not a good idea to miss a really good trade because you're being cheap by a couple of pennies and trying to catch an ECN rebate. And that does happen to me sometimes. But for the most part, momentum stuff, I am trying to take the offer, but otherwise I'm bidding in. Like if you remember when I went over the pins execution yesterday, that was a mix. There was a couple times where I was explaining where I was like bidding in because I was trying to get filled in spots where I thought it could get filled, and there was other spots where I was like, I need the stock. If this thing breaks highs, I'm just going to put in a buy stop for the execution on that, even though it's going to be a take liquidity order. It's going to be a market order because I need to be getting in because this thing is just exhibiting momentum and it's not letting me in on those bids. And what ended up happening at the end of the day was it was actually a bit of both. There were some spots where I was taking the offer, I was upticking. There was a couple spots where I had a buy stop to buy more, and there was a couple stops where I bid in to get more. But generally, I try to bid in whenever I can. So I hope that helps. It definitely depends on the specifics of the stock. From Sebastian, take a look at Spewer for tomorrow. Yeah, I know Felipe was already talking about this when the market closed, I think. Yeah, looks fantastic. This thing's already given us a few good trades, and it looks like it might be setting up for another one. 2 days ago was the last time we had a buy setup for this thing. It was a great trade through, $18. I think some of you guys are still in it. And then yesterday was an inside day, so we had this actually on the radar for today, but it never broke up. And now it's given 2 inside days in a row, so that's furthering the time correction. It's letting this ADMA catch up even more. The thing looks great. Let's keep it on the radar for tomorrow. Next from Tommy. Are you using the same method as the pristine setup for intraday, or more focused on the ADMA during momentum moves? It's funny how often I get questions about whether I use the pristine method. I don't really officially know the pristine method. I actually have access to the program. I've never sat through it, so I don't know. My understanding is that, coincidentally or perhaps not, I have a lot of similarities with the pristine method, but at the same time, it's unique to what I do because I'm really not like I know Sammy Abu Saad, who's a trader that I have a lot of respect for, who is a T3 Live contributor. He's a real pristine guy. He's a pristine method background guy. I'm not. I've learned from a lot of resources. So it doesn't surprise me if it's a method that works and it's a technically based method that I have some similarities with it. But I've learned from a lot of different resources over the years and have kind of put it together in a way that makes sense for me and my trading and my rules. So I hope that is able to help a little bit. Rich is on TradeStation. I actually don't know TradeStation super well. Is Lightspeed worth it if you don't have super large volume? Maybe. If you want, shoot me an email and we can have a discussion about what might be worth it for you or not worth it for you based on your account size and things like that. My email is Oldensmith@t3trading.com. Brandon saying that Pat's note was great this morning. Some super important stuff he hit on. I actually don't remember it. Let me pull it up and take a quick look and remind myself. I definitely read it. Oh yeah. I remember now. Chatter on oil stuff and implications for the market and where we can get oil actually from. Yeah, for sure. Pat's notes are the bomb. Do people still say that? Young guys still call things the bomb? Because Pat's note is the bomb. Thebomb.com. Oh man, just a bunch of nerds hanging out in this virtual trading floor. From Paul here. How do you manage P&L with swings? Even though I am in the money, the net P&L will show negative because of the prior day's close. Should we have a larger lockout due to that with more swings I put on? Yeah, sure. So it's definitely a tricky thing. So your P&L can always be a little bit deceiving on just the front end because the front end engages in mark-to-market accounting. So mark-to-market accounting basically means that whatever the stock closed at yesterday is where the next day it's going to be marked at. But then it's rectified in your prop reports, right? So, if the stock closed, if you have 1,000 shares or something and it closed $1 up in the money, your prop reports shows that you made that $1,000, even if you didn't book any of it. But then the next day, because mark-to-market accounting, it has you marked at that price. So, it's very typical that if you have a great swing trade and you made that, point on 1,000 shares, then the next day the stock is taking a breather. Even people who are swinging this SPWR, which I still have up, stock's down a little bit on some yesterday and today at certain points, but still above where you bought the thing from. It's above our $18 breakout price. But annoyingly, intraday, it might say that you're down. You've pulled back 30 cents on your 1,000 shares. It says you're down $300. And if you multiply that by having 10 swings on, all of a sudden you might be locked out on the day, even though all your positions are still in the money. So first of all, that is the situation where I 100% will give you an increase in your lockout. You just shoot me an email. Hey Derrick, I'm in the money on these swing positions, but I'm being marked as past my lockout situation. I can usually get that rectified for you in under 5 minutes. Just don't expect me to get it done for you, between 9 a.m. and 10 a.m. really, because I'm very focused on you guys and on the market. So if you need that lockout situation to be adjusted because of the gap, you want to try to get me before the morning meeting. Or I try to multitask as much as I can, especially now that I got more screens again here. But you guys probably sometimes see me getting a little bit frustrated when I'm doing 7 things at once and it's 9:40 in the morning because I'm really trying to trade and make money myself. And yeah, what Rich just said, it's very helpful for me if anyone does need those setting changes. if you can put your trader user ID in your email so I don't have to look it up. If I have to look it up, it just takes me even more time to figure out. I don't have everybody's user ID. Thanks, Jerry. I don't have everybody's user ID memorized. So if you can just say, hey, you know, like the perfect email, because it makes it easiest for me, is, hey, Derrick, my swings are gapping against me a little bit. I'm still in the money. My current lockout is set to $1,000. Can you give me a bump to $1,500 today? My user ID is T3DQRS, whatever. And then if I have that information, it just makes it super easy for me to kind of get the email out, as opposed to me having to look up, you know, I got to look up what your user ID is, how much are you down, what's the lockup currently set at, so I can, you know, figure out all that information, because I have to physically make the request as the manager to the risk team. And then it's usually, from that point, it's usually a very quick process. The head risk manager approves or does not approve my request, and the ops team implements it, usually all within 5 minutes. So that's how that process kind of tends to work. And that's also why, for risk management purposes, I keep Excel spreadsheets. Because I oftentimes I've been swinging a lot less recently because of the market environment, but you know, especially when we're in that bull market, I was having 25 swings on sometimes, and I don't specifically remember the pricing on every single thing, or where I last sold some, or whatever it is, and you know, I'm down $15,000 in the day, but I'm really up $50,000 in the positions, and I'm trying to figure all that stuff out. So using an Excel spreadsheet is simple and I think beneficial for that process also. All right, gang. It is 5:05 Eastern Time, and I got a 5 o'clock meeting because it's Thursday. I think it's Thursday. This week, Monday felt like I had traded an entire week, and now that Thursday closed out, it feels like the week just started. So crazy. You know, great job again as a team today, and I'm gonna jump here, and I'll see everybody tomorrow morning. Let's see how we gap. Who knows? Who knows how we're gonna gap? Yesterday I thought we were gonna gap up, we gapped down. The day before that I thought we were gonna gap down, we gapped up. It's been wild. Have a good night, everybody.